Welcome to the HC Insider Podcast, a podcast dedicated to the commodities sector and the people within it. I'm your host, Paul Chapman.
Welcome everyone to this HC Insider Podcast live event hosted by Benchmark Minerals Intelligence, a leading price reporting agency for the critical minerals world. A big thank you to you all for coming. It's obviously a wet and windy evening in London, so thank you very much for that, and thank you again to Benchmark for graciously hosting us. Today we are, first of all, my name is Paul Chapman. I'm managing partner of HC Group, a search firm dedicated to commodities and host of the HC Insider Podcast. Today we're talking about the trading future of critical minerals, the vital importance of these markets becoming efficient, lower volatility and risk managed to the future of the energy transition. What will it take to get there? And what are some of the derailers that might stop them achieving that? Our panel is Guy Winter, partner at Fasken, Matt Ashley, senior Cobalt Trader at Traxys, Jess Fung, head strategist for Partner Investments, and Caspar Rawles, chief data officer at Benchmark. So just a couple of housekeeping things before we start. We'll go for about 45 minutes. I know the panel's pretty pessimistic that we'll get through everything. And then we will turn our mics off and do a private Q&A, and then we'll retire for drinks and networking around 8 o'clock or so. So let's get started. I guess, before we talk about some of the accelerators and challenges to getting to this idea of an efficient and vibrantly traded critical minerals world, starting with you, Caspar, can you give us some sense of why that would be important, what that would mean for these markets, and perhaps give us a little bit of a definition around critical minerals before we kick off as well?
Yeah, good question. I could speak for the whole hour on that, maybe. I think. So first of all, definition in my world, really, I think about the minerals that enable the energy transition or will enable the energy transition. So primarily, that's going to be the minerals that go into lithium-ion batteries, so lithium, cobalt, nickel, graphite, manganese. But also, there's some other minerals that people lump in there. Particularly, people talk about rare earths, minerals associated with renewable energy generation, so silicon, polysilicon, or copper as well. So there's lots of different definitions of critical minerals out there, but from my perspective, I generally think a lot more about the lithium-ion battery minerals initially, and that's probably where I'll spend most of my time talking about them. If anybody else wants to talk about rare earths and other things, they can, but that's for me. And why it's important is, we're really going from what has been a speciality niche sector to scale. And that's already kind of started to happen. And we can see, if we think about lithium over the last few years, that's gone from $8 to $80 to back to $11 or $12. That's a crazy amount of volatility. And when it's a small market, for the people that are in the market, that might be a problem. But broadly speaking, it doesn't impact, the wider economy or the wider world. But as these markets are scaling, we need the way that they're traded to mature, to help with price risk management, to help manage some of that volatility, and to make these markets be, when they're more freely traded, we will help incentivize new supply because people understand what the future looks like, how they can protect themselves in terms of price risk management, as I say. And fundamentally, I think that's kind of where we need to get to the scale that we're talking about to fuel the energy transition.
And we'll come on to this. It's surprisingly absent in a lot of government planning at the moment, the role of private industry. Jess, maybe you can give us, from an investment standpoint, private capital coming to work in the energy transition, why this is also important in your world.
Yeah, so obviously prices drive the top line. And for us to be able to value a project or value some operations, we need to be able to in the first instance, model what that top line is going to look like, how much revenue and cash is going to come in, and then we can add all the costs to that and decide whether or not something is viable. But it's very, very important. And if from year to year, the price is moving up and down by 100% and down by 80%, it's very difficult to be able to say with any conviction, this is a great investment for us over the next 3, 5, 7, 10 years, whatever your investment horizon might be. So this is why being able to have, I think, a little bit more stability in the prices, or at least the ability to think about hedging them or managing them or pricing options, all of the above, any way to be able to structure some more stability in the top line will help a lot, because the costs, surprisingly, can be quite stable, and you kind of inflate them. You know what labor looks like, and you have an idea of what interest costs are going to be, and that type of thing. But that top line volatility really drives volatility in the bottom line, and that can be a problem in terms of being able to value something properly.
Matt, as our resident trader.
Resident trader, yeah. I mean, it's probably a controversial thing to say, but yeah, that type of volatility from a trader's point of view is actually
Quite attractive.
yeah, it's getting me quite excited. That. Yeah, I mean, I think what the basics of why a free traded market is going to be sort of desirable for these types of things. Obviously price origination. But most importantly as well is sort of a trading role is sort of a twofold thing. You've got partly a sort of paper, price hedging, price management system. And if you don't have a sort of an active trading base, you've got nobody to pick up the hedge on the other side. The other bit really, I suppose, the advantage is to manage flows. And I think it's something that people don't talk enough about in regards to critical minerals, and particularly the EV chain. A lot of chat about this is that it's hermetically sealed and whatever. Well, experience of COVID, experience of Ukraine, experience of, God knows what else is coming, an invasion of Taiwan possibly, shows that, you cannot have these linear supply chains, and that you need really an active trading base, a free market base, to manage those flows from a physical point of view as well as a paper price management point of view.
Yeah, you can see obviously how Europe managed the energy crisis.
Yeah, exactly.
As a result of a freely traded energy market. Right?
Yeah.
Despite some of the headlines and so forth. And,
yeah.
And I guess, Guy, from your standpoint as well, I mean, it would make for a more stable world in terms of contracts and transactions as well.
Well, I think the really important thing, Paul, if you take a step back from this, you're talking about energy transition. And as soon as you start to look at the drivers for energy transition, the challenges that we have in delivering what is, the biggest capital program since the Industrial Revolution, there's an absolutely enormous spend, and I know Benchmark have some great numbers to actually, bring those to life. The amount of capital that you have to bring. It's impossible to have the certainty to achieve any of this without any kind of transparency. And you're also asking yourself, what energy transition do we want? So to start with, in the early days, maybe not all of the questions have been asked about the provenance of material. But I think as we move into the next stages of energy transition, we're asking ourselves about the sustainability as well. And I think one really interesting thing in terms of the regulatory backdrop is to see provisions like the EU batteries regulation come in. Now, you could argue that that's a wolf in sheep's clothing in some ways in terms of European protectionism. In fact, you could argue it's a wolf in wolf's clothing because it's so blatant how they've tried to achieve it. But at the same time, there are some really, really important underlying fundamentals in terms of passporting for batteries, and all of these will drive a greater sustainability agenda. And it will also go to form the markets that we will all be participating in the future. And so we can't lose sight, ultimately, that what everyone wants, everyone in the industry wants, is a just energy transition and a critical minerals sector that is fit for purpose for the energy transition that we need.
Yeah, which is a tough one because, and we're going to talk about true price, right? That's a key part of this discussion. And I think William Berg's in the audience at the moment who we talked about the EU battery regulation. Because on one side, in order to get to more efficient markets, there's this drive to need these products to be more commoditized, more fungible. On the flip side, you've also got these other pressures that weren't present 20 years ago about provenance and attribution and so forth. I mean, Jess, maybe you can, Caspar, how do you, can we just talk about that idea of, because you've got products like cobalt that are much more commoditized and fungible, all the way through to the specialty chemical world that is a lot of these minerals. How do we, is it even feasible, and how do you get to a point where there is some level of commodification that they can be more traded, more risk managed? I give bad direction there, so whichever one.
Well, I sort of, as I was thinking about critical minerals in this podcast today, I was thinking about the iron ore market and how that developed, 15, 20 years ago. At the time, it was a really opaque market. The price was set once a year, and it was between two very large, it was a large supplier and generally one large consumer. And there wasn't a lot that was known about it. At the same time, iron ore is a concentrate product that comes out of the ground, lot of different grades, lots of different deleterious elements in it. And what occurred over, probably 5 or 6 years and really came out of the ascent of China, was a much more liquid market that also had some standard prices in it. There's a 62% iron ore, et cetera, et cetera. So I think that's something that can happen with critical minerals. And, that's one of the things that Benchmark does is they try to figure out what is the standard product on which we can provide a price quote. And then everything else, that is sort of around it gets premiums or discounts. And that's the way that the market is going to trade. We also have to think about where the supply and the demand are because, what is the trading route and are we going to do it on an FOB basis or a CIF basis or whatever. But those are the things that I think can happen in the for critical minerals. But somebody needs to take the lead and it needs to happen. And eventually we will go from, rather opaque markets to something that's hopefully a little bit more transparent, possibly even on exchanges at some point. So.
Yeah, exactly. It's funny, when you were talking about iron ore then, you were saying, it was a single price set for the year. that was lithium a few years ago. And, and a lot of these markets have gone through to, move more towards market-led pricing using, prices, benchmarks prices or PRA pricing. But I think there will need to be some commoditization. I think fundamentally, the markets are going to get closer to something like a commodity. I think maybe not what we consider now like a true commodity just because of that speciality nature and the real strict requirements on purity that we see for lots of different battery chemicals. But, it's something we were discussing earlier as well is that, everyone's looking at these markets in that they need to get to a place that somewhere like iron ore is or maybe copper. But, the technology is there now to trade these in a different way. Why can't we look at different technology solutions to be able to trade, to Guy's point, sustainability criteria or provenance criteria can be attached to it and various other metrics that people want to use and think about the way that we do trade these commodities. Can we rebuild it in a better way? And, I think exchanges will be a piece of the pie. There's lots of other solutions out there as well. But, fundamentally, whatever it is, how the market moves, if we're going to go from, like a single lithium market, 1.2 million tons this year, 3 million tons by 2030 and a much bigger number by 2050, that we are going to need to commoditize them to some extent.
Guy?
Yeah, one really interesting thing I think will be to see black mass pricing come through as well, because, obviously one of the drives that we have, and again to reference the EU regulation, but you see a much greater demand for recyclate, and so European recyclate you would expect will attract a premium over time, because if it has to be 15% of all recyclate that is used within the EU, you don't have to be a rocket scientist to see that is going to attract a premium along the way. And so I think, again, to Caspar's point around the commoditization, it can't go on as it is where you literally have got 3 different, one refining plant that is producing different spec product for 3 different off-takers. So there's going to have to be greater commoditization, but then maybe also there's going to be some bifurcation in terms of, is something a EU spec? Quite frankly, the one thing we were hearing in Durban was that a lot of concern from African producers that actually they won't be able to comply with passporting rules. And so even though at the moment everyone is saying we'll be selling the top premium product, are you actually able to do that? So the market could simultaneously get more commoditized, but also broken out into different price points depending on those different criteria.
Yeah, this tension between decommoditizing again for attributes, but the need to actually commoditize. Matt, we were talking beforehand about, cobalt, that, with all this group of critical minerals is on the leading edge of being commoditized and is traded and is an efficient market. And now on the now on the exchanges, and that's brought a whole new group of participants in that have an impact. Can you just tell us that journey?
Yeah, well, I mean, just as a quick comment, I don't think we should exaggerate too much, like the idea of commodification or whatever is in the future. There's already like a very active base for all of these things already. You know, it's not necessarily new. I think the debate is more about how this thing develops. You know, how it develops, and the dangers to that, which we'll get onto a bit later. But no, I mean, if you take something like cobalt and lithium, to answer your point, I mean, I think the last 24 months, particularly, you've just seen a total sea change, really, with the CME, particularly, you know. And it's changed the way that people have traded continually. And it's through that, I mean, as I say, if you take cobalt specifically, and any cobalt traders in the audience will know this, is that cobalt traditionally, something like that, is a positional play, you know, so you're long or you're short. And you would go years of, you know, or so a year of never selling anything, only buying, and then another year of only selling, not buying, etc. Well, things like the CME have changed that fundamentally, where you can buy physical, you can hedge on the CME in a way that you could never previously do that. And that type of development has now opened up the door to, I think, an increasing number of hedge funds, banks. We see banks taking risk, which is quite sort of interesting. Bridging the gap between OEMs and traders on the other side, taking pure risk. The key thing is, can it grow? Can it continue to grow? And I think it will, because something like cobalt, for example, where the real sort of development is, it's always been, you know, relatively small market, really, comparative to, you know, some of the stuff that everybody knows, nickel or whatever. But the sheer amount of cash that can come in from the sidelines, because of that now, you know, because of the CME, it's attracting more cash, more liquidity, and, you know, then exponentially changing the market.
And does that allow, Jess, that comes back to making it easier to finance and allows more money to flow to those markets? Is that a...
I would hope so. I mean, you know, to Guy's point, there is a lot of capital that is needed to build out sufficient supply for the energy transition. And yes, having I think some reference prices on exchanges, having some standard prices helps. But the reality is that commodity prices are always just generally volatile, and it is a very cyclical industry. And the challenge is, you know, we sit here every day and we look at it, and we're quite comfortable with the fact that, you know, things will move up 3%, 4%, 5% in a day, and then down the next day, and we say, oh, that's all right, that's pretty stable. For, you know, 95% of the investing world, that is ridiculously volatile, and they don't know how to manage it. They cannot get comfortable with it. And so even if we said there's XYZ, you know, million lots that you can hedge cobalt with, they're still going to sit there and say, I don't really understand what is happening here. And isn't cobalt getting, you know, engineered out of batteries anyway? So how am I supposed to think about this? That is the vast majority of investors. And that is the vast majority of traditional lenders as well, continue to think that way. So yes, it will help. I think the commoditization of prices helps, but it is still a very, very niche industry. And let's not kid ourselves that that's what we work in and try to deal with every single day. So that is a challenge. And then on top of that, you've got higher cost of capital that's required because of this volatility. And, you know, you've got a lot of frankly, upstream mining projects that sit there and go, I am not willing to give somebody a 30% return. I think that's, you know, too high a cost for what we have. And I don't believe, you know, cobalt prices are going to be at the levels that are required to generate that kind of return. It's a holistic challenge. That being said, hopefully we can get, you know, a little bit more capital flowing this way if we got more liquidity in the market.
It's a very chicken and egg thing, I think, isn't it? And it also needs some visibility further downstream. I mean, a lot of the, let's say, OEM base needs to step up in many ways. You know, that's been one of the major problems, I think, if you look at investment long term into stuff like nickel, cobalt, maybe not lithium, but like, you know, you have a lack of visibility and people are not stepping up. So you've got very much, you know, a lot of in-depth discussions about, well, you know, we need X amount of this and we need X amount of that. Okay, well, you know, give us a contract. No. You know? Okay. But you build it and then we might take it.
So
seriously, it's a major issue.
So we're going to start talking about the pessimistic side.
No, I know.
About the future of this.
Sorry.
And it's all right, we can go out of order, it's fine. But let's understand that a bit more, right? Like, because a key part to this, of course, is OEM incentives, producer incentives, the supply chain incentives to operate in an open market. And, you know, and again, it's not like you've got an energy world that's very familiar with commodity risk and financing and so forth, right? Sophisticated purchasing sales teams, often they have trading teams. It's very different when it comes to an auto manufacturer, whatever it might be. Can you just, I guess, unpack that, and we'll let everyone else comment on it? Just what, I mean, why are they not?
I suppose because they want to have their cake and eat it. I mean, I suppose the problem with the battery, the sort of EV story, it's outside of China. I mean, the EV story in China, as we know, is very rapid, it's very fast, it makes sort of fast decisions. The sort of pattern of EV implementation in Europe and America is a much slower process. It takes a lot longer to make decisions. It's starting, not totally from scratch, but it's somewhat behind China, as we know. You know, a lot of these guys are working on 6-year plans or 10-year plans or stuff like that, you know. One of the key problems within that, there seems to be a lack of decision-making or basic indecision about a lot of the battery technology itself, you know. And that's stalling a lot of stuff. Then you've got other factors, things like, you know, I'm sure we'll get onto this, but things like the IRA, a lot of the legislation, you know, to be fair to a lot of the, you know, the OEMs, etc., it's quite hard to make $1 billion investment in something if you're not entirely sure what's going to happen on a geopolitical / regulatory level, to be fair to them, you know. So you've got all these blocks, you've got like, and that's just for a long time scale for everything. And then you've got these other parameters in there which are sort of preventing the decision-making process. So understandably they're approaching the market, I think, and saying, well, you know, yeah, all right, you produce this and you build capacity, whatever, and, you know, in 5 years' time we might take it, or we might not. Yeah. But are you going to invest money on that basis?
I think that's it, right? It's a totally new supply chain for them. Be built. And not only are they, you know, having to either build a new plant for EVs or retrofit these plants, and they need to do it at such a scale to make money, because frankly they make very, very small margins, you know, automakers. Now they're also sitting and saying, I need to procure batteries that are worth, what, 1/3 of the value of my production, which I've never had to deal with before.
Exactly, that's a very new thing. That's the other thing. It's a cultural
and the technology is volatile.
Yes, and now I have to also understand mining to figure out how I'm going to get access to these critical minerals.
And I've got to find the DRC on a map and all these sorts of things, you know. But it's true. It's true.
Yes,
it's true.
Yes.
It's not. I mean, it's not just that as well. It's that, you know, even now, the majority of automakers are buying critical minerals in batteries, right? They're not going to mines and saying, I want to buy this MHP that I'm going to then have tolled into nickel sulfate, and then I'm going to have, you know, pecan made somewhere. All of that's completely new to them. So it's not only understanding the battery technology, commodity markets, there's a huge learning curve that's had to happen over the last, and, you know, has happened over the last few years. And we're really getting to the time now where we're going to start to see a lot more automakers getting directly involved in the upstream, the kind of mining side of it, or the battery chemical side. And there'll be some learning there. And then do we see more mine investments? Maybe. We'll see. I mean, you know, it's very much outside of the wheelhouse of an automaker generally to buy a mine and operate a mine. So, you know, how do they do it? How do they structure it to protect themselves against the volatility, but also, you know, not to overpay?
Okay.
Moreover, you know, everyone talks about that somehow it happened that all these value chains ended up in China. It's not any type of coincidence. Like, there's really, really good reasons why this stuff is done in China, because, you know, a lot of the processing of these materials
pretty nasty.
is nasty. It's toxic. You know, even absent the sort of ionic clays, like really awful histories of pollution. The fact is that it's capital intensive. It's dirty. And so there was a lot of good reason why the West allowed this to migrate. What I don't think anyone realized was how strategically important it would become with the EV transition. So we're now in a situation where you allow entire value chains to evolve over 20 years. And again, I think it's extraordinary. People talk as though China is standing still whilst we're catching up. Like, of the total global investment in critical minerals, you know, in 2023, the Chinese players represented a massive proportion of it. So the question isn't how much we're catching them up as to whether we're even standing still. I mean, when you talk about the UK, we're running backwards. But I mean, we in the sort of ex-China West. And so actually, as soon as you kind of understand it that way, it's not surprising, and I agree completely, why on earth would an OEM want to go and build a mine, and then someone says, actually, it's in the PCAM that all of the value is. So suddenly I've got like ore, I've got concentrate, but now you're telling me that all of the value is going to get taken out in the PCAM process. So I build PCAM, and then they say, actually, it's the activation process that is where the value is. And so it's like that game, whack-a-mole. Like all the time, you're looking for where this sort of value leakage is, and you whack it, and then it turns out that it's completely different. Now it's cell assemblage. There's all kinds of points in the value chain, and unless you look at it at a really sort of integrated way, which frankly no one in the West has so far, because even in the most sophisticated views of it, it still involved licensing in Chinese technology. It's really, really hard not to lose your shirt. And frankly, almost all OEMs know that they're going to lose their shirts on everything short of actually taking material that smart guys can trade for them.
The HC Insider podcast is brought to you by HC Group, a retained search, intelligence and advisory firm focused solely on the global energy and commodity sector. With 6 locations across Asia, Europe and the Americas and over 50 consultants. To find out more, go to our website, hcgroup.global. There, you can also sign up for our HC Insider content for more interviews and white papers on relevant trends and talent impacts in the commodities world.
But is that, and I might have got this completely, I'm clinging on, but the traditional method of an OEM is yes, right? I'm going to vertically, I'm going to secure my supplier. They can't, can't sell to anyone else. They work for me. And the mindset is therefore to do the same with these new technologies and with these raw materials that go into them. And in part that's because there is the absence of a vibrant traded market. Is that
I would argue
part of the puzzle. But
yes, I think that's part of I think it's part of the puzzle. Exactly. They can get steel from almost anywhere. There's a lot of glass manufacturers now. Aluminium, rubbers is readily available. So I think that is part of the problem. But frankly, there's just not an understanding of how this is going to evolve, and there's not high conviction outside of China, to be honest, that this is really going to take off in the way that it's that a lot of us know it's going to take off. But
people like the headlines, but it's like whether there's still a doubt, I think, in a lot of these guys' minds whether this is really going to happen. But to create that certainty is what you need. You need some certainty, and that, to be honest, if we're going to have a vibrant traded market and all this, I think you need large scale, to be honest, massive state action. But not just incentives. I mean, it needs real engagement.
We're obviously talking deglobalization. The big topic in pretty much every podcast we do, right, is coming up, and obviously now this is very much at the strategic level within governments, the good offices of Benchmark and at the Senate and so forth. It would, that itself though creates a lot of distortions, whether it's the IRA, whether it's the EU battery policy, create a lot of, uncertainty about whether that supply chain is going to, what we've seen in solar, for example, will it shut that down? That again make it very difficult for it to be a freely traded market in the new technologies, new minerals for the energy transition. And that again results in higher costs and higher volatility, right? I mean, yes, it does need state action, but that comes with a series of challenges for just this kind of...
But I think it's a bit more existential, mate. Without it, you ain't going to have anything.
Yeah, I think for me, the question is, because these markets are growing so quickly over such a long period of time, volatility is inevitable, right? We're not going to be able to get away from that. But if we mature the way that these commodities are traded, it means that you can protect yourself from that volatility to an extent. I mean, everyone's exposed to some degree, but that means that you won't have huge companies going theoretically going bankrupt. Like at the moment, the downstream, the automakers, they wear all the price risk effectively, and there's not adequate tools for them to be able to protect themselves, and there's not necessarily easy ways for other people to come in and take some of that volatility, trading however they may do it. So if we do that is another lever to enable us to grow these supply chains as quickly as we need to. If you have huge companies going bankrupt, it does tend to upset further investments in the future. So yeah, it's an important piece of the puzzle.
Yeah, Guy.
Well, you touched upon the IRA earlier, and so I don't want to sort of jump into that out of sequence.
Please go ahead.
But ultimately, the IRA, that's like a capital black hole, and in terms of ex-China investment. But fundamentally what it is inefficient because it's strategic globalization. So instead of having the full-on globalization where everything migrates to the place that it can most economically and efficiently be produced, what you're saying is, where can that be done within places that have free trade agreements with the United States? So then you look around and they chose their places quite well. When you look at Aussie and Chile and Morocco is a really, really interesting one, I think, in the sense that actually shows how winners can be created from this kind of, it's sort of like, Casablanca or something. These little oddities that spring up from the tectonic plates of geopolitics. But I think what we're seeing now is the spheres of influence are opening up. And so, when people talk about an ex-China supply chain, and really the interesting thing is who all gets to be in that, and how other yet more complications in terms of the alliances. The EU has a really vital role to play. I like to think that here in the UK we would buddy up with the EU. There's a bit of history with that, as you know. So I really think that it's a modified globalization, and the interesting thing will be how efficient ultimately that proves.
Because theoretically, of course, you're no longer choosing the cheapest economic point of production, right? You've now got these two spheres of influence. They're growing further apart. You're either in with the DOJ or not, whatever you want to talk about on that one. Like that does in the end, that will mean prices are higher, but also to your colleague Simon's point, I mean, these are very slow builds as well, right? I mean, to put a lithium, a battery plant together, it's 7-10 years. I mean, this is not a insignificant lift. I mean, Jess, I guess that's your world.
Yeah, I think there is increasing friction that will need to get priced into. Not only the commodity prices, it's going to make its way through the entire value chain. The only thing I wanted to add to Guy's point is we talk about an ex-China supply chain. That's the way that we simplify it. The reality is there's probably 2 or 3 other spheres that are actually developing in the world. If anyone's been to Riyadh, to the Future Minerals Forum, that there is a very, very strong push for a Middle East, kind of Eastern Europe, a little bit of Western Asia, down into Africa supply chain that is really trying to get built there in a very similar sort of way that China managed to build out its supply chain. Lots of capital available, lots of energy available, et cetera, et cetera. So there is an interesting sphere that is already occurring there. You also have, obviously, China, which is tied into Russia, let's be honest, and Korea and Japan that are also trying to figure out exactly what sphere they're going to be part of, because are they going to join, the U.S., or are they going to do it where it makes the most economic sense? So, all of these are going to add to the cost of production. They're going across the entire supply chain. And so when we talk about, let's have the adult conversation about what the true price is going to be, that's what we need to be talking about, including the sustainability bit as well, which is a huge part of the puzzle.
Is it right in saying the general assumption at the moment is that whilst these supply chains are going to be blocketized, so to speak, the end product can be sold anywhere, right? And this is what we see at the moment with the expected flood of Chinese cars coming to Europe at half the price of the cheapest, lowest model in the US at the moment. I mean, can you just talk to that a bit? Because that plays into this true price bit as well.
Well, just very, very quickly, Guy was talking about how China has been building the supply chain for the last 20 years. It was inevitable that after processing and refining and building batteries, the next thing that was going to come out was the entire car.
Yeah.
So that's where we're at.
Yeah. I mean, yeah, I think we may see that obviously disrupted by policy. And I think that's what's, to Guy's point earlier, you've seen that in Europe, you've seen that in the US, where there is a move to protect local industry, whether that's via tariffs, via requirements on subsidies, various different things. But yeah, I think, China's sort of scaled their industry so sufficiently that they are the most cost competitive, obviously. And that, we will be able to reduce costs, in Europe or North America, and subsidies obviously helping that right now. But there's a way to go. And I think, policy is, well, my view, particularly at the moment where we see prices generally across the board for critical minerals are pretty low, policy is the main driver of the industry at the moment. Like, that's really driving a lot of the investment decisions and a lot of the way that people are looking at the space at the moment.
Except, sorry, can I just say, the one thing that is interesting about that is when I put my investment hat on, tariffs are not a good reason to make an investment, because historically, and maybe this is part of maybe I'm in denial of what deglobalization really looks like, but in the past, we've talked about protectionism, that's been around the industry for many, many years. And now there's this whole tariffs and CBAM and sustainability and battery licenses. And I sit here very skeptical if that's really going to be stable and structural enough for me to hang an investment decision on. That's just my perspective, and maybe it's because we're the marginal investor, and so we end up taking quite a bit of risk in there.
I think you play through political volatility that we're seeing throughout the West, right? Feeds into policy volatility. You've got deglobalization, which is manifested in protectionism, right? Which, that becomes a war, a battle, as opposed to necessarily sort of an ordered process. I mean, I'm just thinking of the four of you. I think I want to be Guy most. The lawyers will win, and this is the
well, that normally plays most reliably over the period. But I agree with you so much, Jess, because I think it was really interesting. There was a lot of talk about weaponization of rare earths a few years ago. And this is the one that has kind of stuck with everyone. I actually think, and maybe it's not a bad thing, it went under the radar a bit, but lithium has been weaponized. So when the IRA came out, so CATL suddenly announced this deal. And they basically, all of the Western cell makers, such as they were saying, you're going to have to suck up the extra cost of the product. And CATL actually offered a deal where they would eat the additional cost of any swing in the lithium, which I thought that was an incredible statement, because firstly, there's no way to hedge that on, with a traditional exchange hedge, as we've discussed. But also, what they're basically saying is, we've got this. At the lithium value chain, essentially, we can control the price of it because we have it sufficiently end-to-end. And, that was a huge message, because what they were really saying is, however big the tariffs are, we will ensure through other points in the supply chain that we can still make the Chinese product more competitive. I mean, that is an extraordinary message, and I think when we're all driving BYDs, in 5 years, we'll probably remember that.
Well, and it's not there's an analogy what the IRA has done to Europe in some ways as well, right? I mean, it's not just China and ex-China. We've got a couple of minutes left. I just want to talk true price, and I'm particularly interested because I've yet to have a conversation where someone's convinced that the end consumer is willing to pay for some of these crucial attributes, unless they are mandated by a tax. And again, that just means these prices are going up for consumers. But can you just, I guess, Jessica, can you frame up what you mean by true price and how this plays into this discussion?
Yeah, so to me, true price reflects everything. When we talk about sustainability and what the energy transition is a big part of, the true price reflects all of that. So it reflects not only the cost of production, it reflects fair wages, it reflects however we want to think about emissions, whether it's through carbon prices. It has to reflect a true cost of capital. So CATL subsidizing their lithium volatility is actually just because they have such a low cost of capital and they can afford it. All of these things together, and the consumer will have to pay for it. eventually in some form or other, maybe not on the price tag, but in some form or other. And the reason why we don't talk about it is because policymakers refuse to acknowledge it. And it's not a politically great thing to say that the price of everything that you guys are going to consume is going to go up by twice as much because we've decided on a battery passport.
Yeah, I think maybe consumers haven't realised that all of these great sustainability drives at the cost to the consumer. Like it's going to add cost. There's no way around it. And at the end of the day, I don't think that's being priced in. I mean, obviously, if you want the true price, you come to Benchmark.
Yeah.
Really the price. But we have launched fairly recently, at the end of last year, a sustainable lithium carbonate price grade. And what that reflects is, so as part of the work we do, we have a sustainability division and we do reporting on the various different critical mineral worlds, all the different producers, and look at them across about 79 different sustainability metrics. And the tier one, the best of all the producers, we price that material and show that, where that's trading relative to the market average, let's say. And it's not always, at the moment, it's not necessarily been the case that price is higher. So there is, at the moment, the companies that have invested in sustainability aren't necessarily seeing that return. So we haven't felt it yet. And, there's many reasons for that. Part of that is also that the more sustainable companies tend to be larger. So you see volume discounts in terms of what they're trading. But fundamentally, one of the big questions we get all the time is what's the green premium? And at the moment, it's not priced into the market. Maybe that happens in the future, but no one wants to agree to a premium. No one is going to write into their contracts, I will pay a premium.
How many people offset their carbon on their flights?
Yes, that is. I like asking that question.
Do a show of hands on that. But just one final piece. What seems to be, and I think I mentioned it before, but what seems to be absent from many of these policies, I think it's just a critical point for this panel to mention. Whether it is the IRA, whether it is EU battery policy, EU Critical Minerals Act, there doesn't seem to be any engagement with the trading community. It seems they're absent from all these discussions. And, which is what I find remarkable, right? If you're in Europe, that's the home to most of the world's trading houses. They're an incredible asset to have about figuring out some of these supply chain challenges, whatever role they end up playing. But it doesn't seem like that's a live discussion, which is the genesis to this discussion today, right, is really actually highlighting and talking about this and some of the challenges and so forth. But it doesn't seem like there's that much engagement with the people who are actually moving and lubricating the global supply chains for these commodities.
None, really, that I can see. Maybe they're just not ringing me. I don't know. No, I don't think there is. I think it's a cultural thing. I mean, let's take the EU, for example. Let's take a sort of a slightly random example about REACH. Any of us who've had the unfortunate experience of having to deal with REACH on a regular basis, years I will never get back in my life. But when you look at that, you look at how REACH works. It's only a technical point, but it sort of explains the mentality. For example, REACH.
Can you just explain what it is?
Oh God. Yeah. Yes, it's a sort of a registration system for people importing a wide range of metals and chemicals into Europe, basically, to track and trace and make sure that people aren't throwing it into rivers and this sort of thing. But when you dig down on how that works on a day-to-day basis, there's a whole set of strange assumptions in there where I can't explain this. It never sort of acknowledges that there's traders, for example, in the first instance. So you have things like ORs, only representatives, and all these things, which are quite technical. But at no point does it really acknowledge that, you can have traders, And that's a keystone. Now, obviously, we all get round it, and you register in certain ways and whatever. But it's a key. It's just a mentality thing. It's just like a cultural thing. They see traders or whatever. As whatever, making money, etc. As in fact, really, what you are to an extent is a service provider.
Yeah.
But they don't see it like that. It's not even on their radar. It's people produce things, and then those things go to people who consume it, and you have this sort of Soviet-style sort of system where things just go from A to B, and that's it. And there's no recognition of what I'd call shock absorbers or liquidity or optionality, how things move around. And as you say, Europe's home to the biggest traders.
Yeah, which is also on the part of the traders themselves, which has historically been a more opaque industry, right? It's not like there's been much engagement as well.
No.
But, you know, and I think that story plays out in what's happened in the energy crisis we mentioned at the start.
Yeah.
Okay, final question, and perhaps just go down the line. It's, you know, we tried to sort of think about how could we sum this up, and the easiest question we came up with was, in 10 years' time, will every trading house have a lithium desk?
Yes.
There you go.
I believe so. I think it's you know, it's energy, right? Or everywhere that has an energy trading desk should have a lithium trading desk. Or, yeah, I think there will be.
Yes, I agree. The lithium market is going to be so large in 10 years that it will make sense for everyone to have a lithium trading desk, and maybe Benchmark will be, you know, providing the pricing.
So we will.
Yeah. We have one, you know. Yes, it's a key component, because what you've seen within most of the trading houses is trying to move into this sort of, I mean, it's slightly contrived, but this sort of idea of a battery metals team, you know, EV space, etc., like trying to create teams of that. There's a few challenges to that, because I think what you turn out is you've got some nickel traders and some cobalt traders, some lithium traders, and trying to herd pigeons. But yes, I mean, it's a key component of where people are trying to go, you know.
Okay.
Yeah, I mean, I'm not going to argue with the more august characters to my left now, but also the thing, I'll also be really interested to see what other new traders there are. Will we have vanadium traders, you know, more PGM traders? We don't really know where this battery journey is taking us. Pretty confident that in 10 years we're going to have a lot of lithium, but there's going to be other metals that really come to the forefront of energy transition, which is one of the most exciting things about it all.
Yeah.
So Matt might be a vanadium trader by then.
Never know. And Jess, you did say something really interesting, which was, it doesn't mean, though, it's going to look the same as trading today, right? New technologies, whatever that might be, and so forth. But there's not necessarily going to be, it might not even be humans, right? But it won't necessarily look the same as today's markets.
I think so. I think there can be some very, very interesting structures that will get priced in, and you know, Caspar was saying as well, we've got the data and the technology and the speed and the information there, and frankly AI. So there is going to be a very, very interesting way to trade many, many commodities in future, I think.
Right, we'll leave it there. Well, thank you very much. I think excellent panel, really enjoyed it. We'll open up for Q&A, but firstly, thank you very much.
Thank you for listening. If you enjoyed this episode and want to support the show, please give us a positive review on Apple Podcasts or Spotify.
To find out more about HC Insider and HC Group, a search and advisory firm dedicated to the commodity markets, visit our website at www.hcgroup.global. There you can find out more about our services and our offices around the world. There you can also find more content, from interviews to insight pieces to more podcasts focused on the commodity value chains. Thanks again for listening.